On September 15, 2008, Lehman Brothers filed for bankruptcy. Their debt-to-equity ratio? 30 to 1. Meaning for every dollar they owned, they owed 30. And that math didn't just break a bank. It broke the global economy. Debt is the most misunderstood force in investing. Some companies use it to build empires. Others use it to dig their own graves. And the line between those two outcomes comes down to one ratio most investors never bother to check. I've watched this single number predict blow-ups for 50 years. Graham warned about it in Security Analysis. Buffett obsesses over it. And today, you're going to learn exactly when debt is a weapon, and when it's a time bomb quietly ticking on the balance sheet. Because here's what nobody tells you: the companies that survive crashes aren't always the biggest. They're the ones with the right kind of debt. Let me show you what I mean. Debt to equity is simple. You take everything a company owes and divide it by what the shareholders actually own. That's it. A ratio of 0.5 means the company owes 50 cents for every dollar of equity. A ratio of 2 means they owe $2 for every dollar of equity. And a ratio of 30? Well, that's what killed Lehman. But here's where most investors get it wrong. They see debt and panic. Or they ignore it completely. Neither approach works. Because context is everything. A utility company carrying a ratio of 1.2? That's normal. They have predictable cash flows and regulated rates. A software company with that same ratio? That's a red flag. Their revenue can evaporate in a quarter. So the number itself means nothing. What matters is, can the business actually service the debt when things go wrong? And that question is where fortunes get made and lost. Let me tell you a story that still makes me angry. In 2005, 3 private equity firms, KKR, Bain Capital, and Vornado, bought Toys R Us for $6.6 billion. But they didn't really buy it. They financed it. They loaded the company with more than $5 billion in debt. Debt the company itself had to pay back. And from that moment on, Toys R Us wasn't a toy business anymore. It was a debt servicing machine that happened to sell toys. Every single year, they paid over $400 million, just in interest. Money that could have gone to new stores, to e-commerce, to competing with Amazon. Instead, it went to lenders. And when the retail environment shifted, they had nothing left to fight back with. In September 2017, they filed for bankruptcy. 33,000 employees lost their jobs. The lesson here is brutal. When debt is forced onto a healthy business, it turns every downturn into a death spiral. The company has no flexibility, no room to invest, no margin for error. And this is exactly what happened to Lehman too, but at 30 times the speed. When real estate values dropped just 10%, their equity was wiped out. Their leverage didn't amplify returns. It amplified ruin. 72 hours. That's all it took. Now let me show you the flip side. Because debt, used correctly, is one of the greatest wealth-building tools ever invented. In April 2013, Apple did something that shocked Wall Street. They issued $17 billion in corporate bonds. At the time, it was the largest corporate bond offering in history. Here's the thing: Apple didn't need the money. They were sitting on $145 billion in cash. More cash than most countries have in reserves. So why borrow? Because that cash was parked overseas. Bringing it home would have triggered a 35% tax hit. But borrowing at 2.4% interest? That was essentially free money. They used the bonds to buy back stock, pay dividends, and boost returns for shareholders. That's not reckless debt. That's financial engineering at its finest. Apple's debt-to-equity ratio today hovers around 1.5, which sounds high, until you realize they generate over $100 billion in free cash flow every year. This is the principle. Johnson & Johnson uses debt sparingly to fund acquisitions, and they've held a AAA credit rating for decades. One of only 2 American companies to ever earn that rating. Microsoft does the same. The secret isn't avoiding debt. It's knowing when the borrowed money earns more than it costs. So how do you tell the difference? How do you spot the next Lehman before it collapses? Buffett uses 3 questions. And I want you to memorize them. First question: can the company pay its interest from current operating earnings multiple times over? Buffett wants to see interest coverage of at least 5 to 1. Meaning earnings are 5 times the interest expense. Second, could the business survive if revenue dropped 50%? If the answer is no, the balance sheet is fragile. And third, is debt growing faster than equity? Because rising debt with stagnant equity is how companies slowly walk toward bankruptcy. Berkshire Hathaway runs with a debt-to-equity ratio under 0.3. Buffett could borrow billions tomorrow. He doesn't. Because he knows something most investors forget. Debt isn't a tool for growth. It's a magnifier. It makes good businesses better. And it makes bad businesses fatal. Here's the one principle I want you to walk away with. Debt doesn't reveal a company's problems. It accelerates them. A great business can carry heavy debt and thrive. A mediocre business crumbles under even modest debt. The ratio on paper matters less than the quality of the cash flows behind it. So before you buy any stock, ask yourself one question. If the next recession hit tomorrow, would this company be the one borrowing cheap from panicked banks? Or the one begging for a bailout? That answer tells you everything you need to know. Now I want to hear from you. Which is more dangerous, a company with zero debt but declining revenue, or a company with heavy debt but rising earnings? Drop your answer in the comments. I'll read every one. If this reframed how you look at balance sheets, hit that subscribe button. Tomorrow we're tackling something most investors get dangerously wrong, the myth of diversification, and why owning too many stocks can actually hurt your returns. See you then.